There is now a proposal potentially for a 50-year mortgage. Whenever Trump talks about this type of stuff, and then we talk about homeownership, which is frankly something everyone needs, it usually creates a little bit of a lather. There are pros and cons to all this, and what I want to do is I just want to unpack most of it. You are putting a lot more money towards your principal later in a loan. They want people to borrow more money to keep the economy going. And so if that's the case, then you have to wonder why the government's now is proposing this. Welcome back to another episode of Moving Sucks. We are coming up on our 100th episode, and I have to have our producer actually count them and see. We got to be close. I think we're in our 90s, but welcome back. I wanted to go over something that's very relevant in the news right now. And it's going to get a little political. It's going to get a little bit historical. It's going to get a little bit economical. So the Trump administration has come out with a 50-year mortgage. Now, this was just something that Trump tweeted, but this administration, that's how they kind of test balloon and release ideas. So usually things are studied, they're put through committee and subcommittee, and there's experts brought in, but that's not how this president operates. And take it or leave it, that's what we have. So there was a casual proposal that we would go from a 30-year to a potentially a 50-year mortgage. Now, there was no suggestion that we would abandon the 30-year. The 30-year is from all the reforms after the Great Depression and the New Deal under FDR in the 30s. What that largely did is it expanded credit. So if you can extend a debt out 30 years, it makes the payment go down, right? But trade-off is that the bank gets more payments, and that means they usually will get more interest. There is now a proposal potentially for a 50-year mortgage. Now, there was a potential for a 40-year, especially in the FHA space, like an FHA 40-year mortgage. That never really got traction. The 30-year mortgage, just so you are aware, is still the gold standard of real estate. That is still going to be the safest bet. It is the most understandable, most easily resold on the secondary markets. Not going to get into exactly how loans are bought and sold. That is for another time. But I wanted to address this because this is going to be something that you're going to hear about. You've already heard about. Lots of opinions. And whenever Trump talks about this type of stuff, and then we talk about homeownership, which is frankly something everyone needs, it usually creates a little bit of a lather. Before this, it was mainly about interest rates. And he's still talking about that too. There are pros and cons to all this. And what I want to do is I just want to unpack most of it. So the 50-year mortgage would obviously, if you buy a $500,000 house, it's going to extend out those payments and those principal payments out that long. So basically what you have when you take out a loan is you have a principal payment, you have a principal piece, you have an interest piece, taxes piece, and insurance. So you have to pay for insurance as well. So they call it PITI. It's like PITI. So you've got, those three things. You have the interest, taxes, and insurance that are always there. And then you have your principal. The idea is that when you first take out a loan, that payment, the amount of interest versus principal is skewed very, very much towards the interest part. So the bank in years 1 through 10 will make more money per payment on interest as you go through years 10 through 20, 20 through 30, 40 through 50, whatever. That interest starts to winnow down, and then your portion of your payment is much more principal. So you are putting a lot more money towards your principal later in a loan. The idea here is that if you took a $500,000 house and instead had 360 payments, you'd have 600 payments. There would be, because that's how many months there are, those that would go down. So that number would go down. I have a little bit of a problem with this, not as much from a lending and consumer side, just from what the hell is going on side of things. I was telling my lender yesterday, I have to wonder why that's even being thought of. Why are we doing that in terms of making it where the payments are lower? And I know that most people are going to say, well, it's because of affordability. It's like, yeah, but I think what they're really trying to do is provide access to credit, meaning they want people to borrow more money to keep the economy going. And so if that's the case, then, you have to wonder why the government's like now doing, now is proposing this. The idea of lowering interest rates, that's baked into that. Like, where it's like, yeah, if we make money cheaper to borrow, more companies are going to borrow, more companies are going to hire because money's cheaper. But keep in mind that when you lower interest rates, so do savings rates. So the Fed rate is not just the 10-year Treasury mortgage rate. It is, or borrowing rates. It is savings rates too. So there's always a little bit of a dance between buyers or interest rates going down to make money cheaper, but then people don't get to save quite as much. Interest rates on CDs, that type of thing, they go down a little bit. So this can be a product that someone could use, but when we're talking 50 years, I mean, that is a lifetime of homeownership. I mean, that's from age 30 to 80. The idea of someone staying in that loan for that amount of time doesn't really occur. Keep in mind that in the 1930s, like, people stayed in their house for like 25, 30 years. The idea was to pay it off. And that's how people got tricky and people got smart, and they started prepaying. And there used to be loans that you couldn't prepay because the bank wanted to be able to realize all the interest from all 360 payments over a 30-year mortgage. They did away with a lot of that because they wanted people to use these debts as a financial tool and a way to build wealth. So if you prepay your mortgage, you're going to pay a lot less interest. So there is a great calculator on almost every bank website. But if you go to like bankrate.com, you put in your loan and then you go and you look at like what a principal payment would look like if you paid all your mortgage payments, but then you put like a $10,000 bonus like early in your loan. It'll show you how much interest you're going to save. So a 50-year mortgage, guys, is a really long time. Plus, like I said, those first 15 years of principal, the portion of those payments on principal is going to be a lot less, meaning you are in a 30-year mortgage or a 50-year mortgage. 30-year mortgage, you make 15 years, you sell on the 15th year. 50-year mortgage, you sell on the 15th year, you are going to have less equity. Because you have not made those payments. The money that you've made has not gone towards principal nearly as much as if it were the 30-year. So what it is really like a Band-Aid. It's a thing to get people into homes. And then the idea is I'm going to refinance out of this when interest rates come down. So I go into a 50-year rate. Of course, I'm not going to live in this house for 50 years. Nobody lives anywhere for 50 years anymore. And then in year 5, I'm going to refinance, or year 4, year 2, whatever. And it's very much along that thinking of like, marry the house, date the rate. I don't like that. I don't advise my clients to do that. I don't think it's the right thing to do. I really want people to be comfortable, unless it's really extenuating circumstances, really, really comfortable with their mortgage payment, because that we don't know what is going to happen to interest rates. If we run into some massive like economic cycle problem or whatever, rates will come down for sure. But if the market booms again and like they want to beat back inflation, like rates are going to kind of, they could stay the same, go up. And I never want to tell people to take their financial life in their hands and worry about what Washington, D.C. is going to do with the Fed rate and like what the market's going to do. There is a self-preservation that has to be executed in the middle, in an investment like this. You don't want to be too risky. Now, listen, that doesn't mean that if you get into a house and it's like the payment's like, it's a little tight, but keep in mind, you're going to have that payment. It's going to go up maybe a little bit because, insurance and taxes go up. But the idea is you set that payment and then you start making more money, getting raises. You stay in the house and you start building more wealth and, you get better jobs. And that's kind of how like things have gone. But a 50-year mortgage, guys, it's not a good idea. It would be really, really hard for me to imagine somebody I would recommend doing that for. My bigger concern is about the expansion of credit. So I was telling my team, we were on a Monday morning, this past Monday morning, and we had everything lined up for our daily huddle. And Jen, who's my co-host, who's hopefully going to be back soon, basically said that she wanted to talk about this 50-year mortgage thing, because I think it was on like Saturday or Sunday that Trump tweeted it out. And then the HUD secretary. He's not the HUD secretary. Bill Pulte. He's the grandson of the guy who started Pulte Homes, which is like top 5 home builder in the country. Said, "Hey, this is a great idea." Um, People don't realize that the Great Recession really was. It was not a stock market crash. It was a complete diminishing of credit. And I don't want to get too far into the weeds here, but I did on that call on Monday because I wanted my agents to understand the kind of how the economy works. People, like people walk around like really don't know like what the hell, like how money works and like how this whole system works and like what a bank run would mean or, um, the 90% rule. Like a bank doesn't have only has to hold 10% of deposits. Like you put $1 million in a bank, like 900,000 of that they get to lend out. So like there's a lot of intricacies. And it was the Wild West back in the Gilded Age, which is like the early 1900s, where there was no real regulation, there was no SEC, and everybody was just like borrowing and gambling and investing and what ended up happening, everything came to a crashing halt because the banks couldn't lend. There was no credit, and so when you have a Great Recession or a Great Depression, people just don't feel safe, and so they don't deploy their assets. They don't lend out money. They just want to hold it and like clutch on to what they have. They don't want to do anything risky, and it's very, very anthropological. It's very normal. I've said on this podcast at least a dozen times, like people think this is some like mathematical fancy thing. All economic behavior is just based on humans. It's all organic, biological, gut reaction, mostly emotional stuff. And so, you can go all the way back to the Native American tribe in the middle of the plains and they hear the war drums over the mountain. Like they're not going to go and start exploring. They're going to like huddle back, make sure they've like shored up all their defenses, put all the kids and the wives, who are there for reproduction, put them all in the middle, all the men on the outside and like defend. We don't live anywhere near that world anymore. But when a market crash happens, that's largely what happens. When somebody doesn't feel good about the economy, they don't go and book a vacation. They save money. They're like, honey, I'm not sure. I'm going to make this next round of layoffs. Let's just hold off on spending. It is the exact same thing as a Native American tribe. So when you aggregate that out to a macroeconomic sense, meaning the larger economic picture, there is it's the same thing. Banks, companies, billionaires, soon to be trillionaires, are not going to spend a lot of money. So what they do is they lower interest rates to make it really cheap to borrow money. And so what ended up having the Great Depression is that they could not get the market restarted. There was so much fear in the market. The market had crashed so much that the actual suppressing effect of the market was basically there was no access to credit. Nobody wanted to part with their money. So what ended up happening is the government stepped in and said, hey, we're going to create an environment. We're going to create all these regulatory bodies to ensure that it's a safe environment, a safe construct in which to distribute money. People don't realize in 1933, Social Security became a thing. It's not a coincidence that it was 4 years after the Great Depression when seniors were living in the streets. So in the end, when I see they're trying to add more access to credit, more people being able to borrow, that kind of puts my radar up. I'm like, what is going on? Like, what the hell? Like, why do we need this? And really what it comes down to, it's affordability. Now, the government would argue that it's about like, well, home prices are high, so we want to just create as much access to those things as possible. But there's also something to be said about just keeping like the engine running, and having these tools in place in case all hell breaks loose. So I'm not a fan of this product at all. I don't think it's going to help the consumer, and it's really funny because I've already seen like the political divide. Like if Biden had come up with this, like I'm sure the left, half the country would love it. Now that Trump's done it, half the country hates it. Like whatever, that's an apolitical statement. It's just a matter of like whoever presents it, the other side hates it. So I think we should all hate it. I'm not a fan of it. The math is devastating. So if you get anybody who starts talking to you about this, um, just keep in mind that it's not actually something you can do today. It is. It would have to be passed into law. It would have to be organized, and we can't even get our Congress to agree that the sun is going to rise tomorrow. So I wouldn't bank on it. But I want to get on here and just talk about it a little bit because a 50-year mortgage is something that is going to. It's not going to serve the consumer. It's not. The only way home affordability can be regained, really, and there's plenty of people out there who can still afford homes, but it's tight, and it's tight in other sectors of the market with just goods and services, and daycare, and then just groceries and all the stuff you read about on the news or you see on the news. But there's two ways to make affordability occur. It's pay people more, or the prices of homes have to come down. So there's certain areas of the country that, and I've talked about this ad nauseum. There's a lot of people out there who have markets that are really, really tough. Like affordability is really, really tough. Here, it's not so much. I mean, things are high, but they're still manageable because we live in like a really strong area where it's like good jobs, strong income, and I hope that's clear. If anybody here disagrees with me, leave a message in the comments. I'd love to have a debate with somebody. I'm getting on a national call with Jen. Jen is actually getting on with me tonight with a gentleman named Ryan Alexander. He's a two-time guest on the show. You should absolutely check out an old episode with him. His name's Ryan Alexander. You should go search for it in the episodes. Where it's mostly men trying to get their credit together and get their financial house in order. Cannot imagine that a 50-year mortgage is not going to come up on this call tonight. So I do a lot of mentoring outside of real estate. I do a lot of business coaching, that type of thing. And I've had a lot of people reach out to me just in general, like, hey, what do you think about this? And not a fan. So, but if you disagree with me, let's have it out in the comments, or shoot me a DM on Instagram, and hope we can connect. Talk to you guys later.